If you follow the stock market closely, then you might have seen that Kohl's stock price shot up nearly 50% over the course of 2 days last week. That is certainly an attention grabber. So, what happened? Well, it was caused by a phenomenon known as a short squeeze, or as I generally call it, a short covering rally. And that's what this video is about. In the stock market, there are two main types of forces that move stock prices: fundamentals and technicals. Fundamental drivers are fairly intuitive. A company grows its revenues and profits, and that attracts buyers of its stock because the company's intrinsic value is increasing. This is what comes to mind when I think of investing. Technicals, on the other hand, it's a broad category that captures factors that are, well, not related to fundamentals. Examples include chart patterns, trading volume, and short interest ratios. These are factors that can influence stock prices in the short term, but don't usually tell you anything meaningful about a company's actual value. If you are a long term investor, then these technical factors are usually just noise and can be ignored. Okay, let's talk about short selling, which is basically betting that a stock price will go down. And I'll touch upon how it is a technical related driver of stock price movements. Here's how it works: an investor, or more appropriately, a speculator, borrows shares of a stock that they believe is overpriced, then immediately sells those shares at the current price. And the hope is that the stock price will decline, at which time they will buy back those shares, return those shares to the lender, and then pocket the difference. It's the reverse order of buying low, selling high. It's actually selling high and then hopefully buying low. Kohl's is one of the most heavily shorted stocks in the US, and we can see that by looking at its short interest, which is the number of shares sold short divided by the total number of shares available to trade. And that's something commonly known as the float. Here are the top 10 most shorted stocks along with their short interest percentage. You can see Kohl's there in the middle with a short interest of a whopping 46%. And that's now, by the way. The short interest was reportedly about 66% before the short squeeze on July 22nd. Compare that to the short interest in the top 10 largest US companies. For those names, it rarely rises above 1%. Tesla is a bit of an outlier at a still fairly low 2.5% short interest. Okay, so this is how things can go wrong for short sellers. When short interest is high, it sets the stage for a short squeeze. And this is a technical, and this is exactly what we saw with Kohl's recently. Okay, if the stock price starts rising for whatever reason, maybe it's something fundamental, like a strong earnings report, then the short sellers start to feel pressure. And to avoid deeper losses, they scramble to buy back shares, which creates more buying pressure, pushing the stock price up even more. It's a self reinforcing loop that creates the short squeeze. And I think of it as panic buying, and it can lead to some really sharp rallies in stock prices. GameStop in 2021 is probably the most famous recent example of a short squeeze, but we just saw it with Kohl's. And as I mentioned earlier, the stock price was up nearly 50% based upon closing prices. If you look intraday on July 22nd, Kohl's was up about 105% at one point during the day. But of course, it fell back before the market closed. Now, if you are someone who is skeptical of stock investing, then this kind of technical driven price volatility may just confirm your suspicions that the stock market is a close cousin to a Las Vegas casino. I will say in the example we highlighted, short squeezes lead to higher prices. So if you're just a passive buyer and holder of a stock, you probably wouldn't be complaining too much. But there are market technicals that can lead to significant declines in stock prices over short periods of time. But that's just it. It's short periods of time. It's noise, and it's limited to small pockets of the stock market. If you are invested in a diversified mix of index funds, then short squeezes like this have little to no impact on your long-term results. So while these events may dominate the news cycle, they don't dominate your portfolio. Thanks for watching.